So today we want to talk about Roth accounts. A lot of people have heard this Roth versus traditional, and they don't necessarily know the difference. So we want to talk about the superpower that you can unlock by either contributing or converting assets into a Roth IRA. That being said, most people have a 401k at work or a traditional IRA that while they're in their earning years, they take as much advantage of as they can because they get a tax deduction in most cases for every dollar that they put into that account. It saves them on their tax bill that year. But unfortunately, that balance over time compounds and grows, and the IRS is just sitting there patiently waiting for you to be forced to start to take money out of those pre-tax accounts. So what we often see with our clients is that at around age 73, they get forced to start taking distributions, also called RMDs or required minimum distributions, out of these pre-tax accounts. And oftentimes they've accumulated so much and it's compounded over such time to where the amount they're forced to take out is well more than they even need to live. So there's a way you can combat this, and there's a few added benefits that come along with effective planning. That being said, by utilizing a Roth conversion, or essentially biting the bullet and paying the taxes on those pre-tax assets in advance, you can take advantage of tax-free growth. And with appropriate timing, working with an advisory firm like ours, you can do it at a really meaningful effective tax rate discount. What that means is oftentimes our retirees come in at around age 62 with this big bomb ticking that's going to go off at age 73. But additionally, they don't have income from work anymore. They don't have nearly as much items hitting their tax return. So we can often kind of take advantage of those low income years and sometimes even do Roth conversions for effectively free depending on their income from other sources. That being said, having those Roth assets are very advantageous because as you get into retirement, there's a lot of things, whether it be Medicare premiums or ACA healthcare premiums if you retire before age 65, that are highly dependent upon your income. That Roth conversion that you did 20 years prior, or that Roth account you contributed to when you were young, can be a source of funds that don't affect your adjusted gross income so that you can qualify to get subsidies for your health care or not pay as much for your Medicare premiums. So I encourage you to work with your advisor or reach out to a team like ours to help determine if a Roth conversion is appropriate for you and how you can do one with the least amount of taxes paid.